Hey guys, hello everyone. Welcome back to my channel. Today we are going to learn a very interesting strategy which is all about creating long-term wealth at a discount. Why I say so is basically because when we try to purchase any of the securities, we mostly purchase it at the traded price. But not now, because now you will get an option how to purchase these securities or stocks at 5% or 10% discount. And even if they don't come at that 5% 10% discount, you will have an upside potential to it. Let me explain you how. So what is that we are going to do is that we will first select a stock in which we want to trade. It could be a large cap stock, because and I would recommend that you only trade this strategy in large cap, mainly because the stock options are very volatile in nature and there's a low liquidity that is associated to it. We all have seen what has happened to Adani in the recent past, so we don't want to repeat the history. We will be hedging the trade also, don't worry about that. But my recommendation is that we trade mostly in the large caps, basically SBI, Reliance, or all those kind of stocks. Now, for example, I will give an example to explain how it will work. What we are going to do is that we are going to sell a put option below the current trading price of a security. For example, Reliance is trading at around 24.38 rupees. What we are going to do is that we are going to sell a put option at about 5% lower than the current price, which is about 2300, and we will wait for the current traded price of Reliance to hit that value, so that our put option premium comes in the money. Okay, and if it doesn't come in the money, then anyways this option is out of the money. You will be collecting the premium, you will be earning a profit out of it, and uh, you are not losing out of anything. Now again, to explain it again, so what is that we are doing? We are actually selecting a stock. We are choosing the put option with an expiry date, maybe of next month, because that is how you will have higher premium. Otherwise, if you sell it for the current month, which will have like 2 weeks of expiry, you won't collect much of premium and the returns are not great. That is what I have seen. So usually I will be selling options of next month of expiry put option, which are typically in the range of 3% to 5% lower than the current traded price, and that way I will be getting a good amount of premium out of it. And I can also hedge the trade just so that I can lower down my risk by buying a put premium of around 7% 8% down the line, so that the risk is not unlimited in this case. And now what will happen is, if the traded price of that stock doesn't reach to that particular value, in that case anyways I am going to enjoy the premium that I have sold. But if it does reach, if the put option does become in the money, I will be buying the securities at the traded price and I will be investing it. So basically what you have done, you have made the investment at a discounted price. When the price of that stock comes down, and if it doesn't come down, then anyways you will be enjoying the put premium. This is the example that I have put down over here. For example, Reliance is trading at 24.34. We will be selling Reliance put option at 2400. Strike price of October expiry is 38. So this is a very close premium that I will be selling, but I will be receiving 38 rupees premium on a lot of 250 shares. To hedge it, I will be buying put of 2300 expiry at 14 rupees. So the total premium that I am collecting in this case around 24 rupees, which amounts to around 6000 rupees. So I am generating a profit percentage of around 15%, because the margin deployed is around 40k. So that is how the strategy would work, and it's a very good strategy in case if you want to build a long-term portfolio. So you should not be considering deploying your capital at the current trading price. You should always think of selling the put option, and once the securities come at that particular point, then you should execute it. So it will give you a leeway of having higher profit with the same amount of capital. The only caveat in this case is, like, since the lot size is around 250 share of Reliance, so it might be coming in the range of 6 lakhs 7 lakhs. It's a so when you are executing, when you're buying all the shares, the lot size could be a bit problem. But then again, there are many lots which are available in the range of 2 lakhs 3 lakhs also. So you can switch to those kind of securities as well. This is how the graph that will look like for Reliance, in case if you want to look at. I've put it down how after the hedge is created. So basically you are collecting a total profit of around 6,200 on 40,000 rupees of premium, which is about a 15-16% of a good profit. And anyways, if this price of Reliance goes below 2400 minus 38 rupees, because you are collecting 38 rupees and 13 rupees is, so the net is 24 premium that you're collecting. If the price goes to around 2350, at that point of time you can think of purchasing Reliance at discounted price. Even though if you don't want to invest, even this hedge strategy is good enough strategy to generate good amount of profit on stock options. That's it for my side. Again, one more thing that I would like to bring out, that this is all about selling put option. There is one more strategy that can be built similar to this, which is all about selling call options. Now how that will work, I will explain you in my next video. Thanks a lot guys. Thank you for watching. Have a great day. Bye.